All right, you guys. So for this week, we're going to be mostly just reviewing the in-depth portion of what I like to do personally. And I know Jarvis, Hassan, and Kenny all do the same thing, but mirroring the option chart with the actual stock chart is one thing that I've become accustomed to in the past few months to a year now. And I would say the main focal point with why I do this is mostly it lowers my risk significantly, knowing exactly when and where I'm going to buy in based off the actual contract price and not just the actual stock share price with the price action. So it's more so like when I'm pulling up and looking at the overall picture, like on the left side, we have just Amazon's chart from this past Tuesday. I believe it was Tuesday. It was either Monday or Tuesday when I got this picture, but I put up the option chart for the logical buy you would do, I want to say. And I wanted just to bring a few examples into this and just speak on the foundation of it, why I personally feel like it works for me and it helps me lower my risk long term. It also helps me identify a play before I even execute. So I know beforehand, number one, how much I'm going to lose on the trade after my execution goes in. Number two, I know the possible reward if the trends hold and the play works out the way that I expect it to based off zones or a pattern formation. And of course, the biggest thing, which I like to save for last, is I know exactly where I'm going to enter the contract at with a rough estimate between a bid and ask type situation. So this first example, and as I talk, if you two have questions, anyone else that comes in, I'll reiterate things. But the biggest thing that I like to show people first is the week of expirations and how exactly they move so much faster. They're not as a mirror picture, you could say, with the stock price action, with also the contract price action. So with Amazon stock share price being on the left, and then the right side we have the this week expiration, the 105 calls for Amazon. At the time when the screenshot was taken by me, so I could chart this and do the mirror image and give you guys a few examples that I have with Amazon, Apple, and SPX. I mostly just wanted to find examples with the week of, the next week, and then possibly a month out so that you guys can actually see how the reward may not be as big as you add time to contracts, but it saves you a lot of a stress headache. It saves you a lot of emotional stability when you're in a trade. It just saves you from the effect of like, what if I got in too soon? What if I enter too heavy and I'm losing too much? Like, what if it bounces back after I sell? The biggest thing I tell people, there is no such thing as a loss in a trade if you enter off a plan that you have preset before executing the entry price. When I tell people that, it's kind of like, why would I still be happy if I end a trade red? When you prepare for a trade, you're not just focused on the money I can make. For me personally, when I'm focused on a trade that I want to enter, I'm only focused on, before execution wise, I'm focused on what's the possible risk if I enter at this price per contract based off the price action the stock share is giving me. So with this example of Amazon, as you can see, this trend of making higher lows, kind of having the same resistance on top at open after the major drop off. If you correlate this consolidation with the Amazon chart for the week of, obviously the price for Amazon at this consolidation as it's making higher lows, it is around $100 per share. And the contract price on the right is $105. So it's $5 out of the money, which for beginning of the week, if you're playing week of, it is a high risk. But this is one of those contracts you can size extremely light. If you're expecting to lose the full amount you're sizing, you can afford to swing this in case of a breakout that happens, and your contract can come back if it's down 50%, 60%. From the outside look at the percentage wise, it's like, man, I'm down 50%. Like, do I really want to hold this? Before you entered this play, say like with the orange highlight is on this pullback, I had a level at 0.26 per contract. So just going off this setup, obviously when looking at Amazon Foreman right here, we don't know that this bounce is going to happen. This level I have at 100.45, this was a zone historically that I charted out before market open on this day. It was before I even knew what was going to happen. I had a level between about $100.30 a share to $100.50 a share. So I try and find a basis point, and actually I moved this exact level up a little bit. It was down slightly more. So the actual pinpoint of the bounce was not dead on like this screenshot shows. I just want to bring up the example for the visual effect so you can understand the horizontal line that's orange on the price for the stock share is also the same area on the contract chart. It gives you a good visual when you're focused on chasing a play or trying to make execution work when you've missed your initial entry. I always tell people, if you miss a breakout, like how Amazon broke out here after finding that buying pressure, after breaking the resistance at the $100.45 a share, it had that breakout to basically the pre-market open price. It tapped out there and pulled back. If you would have chased this play at any point after, say, 10:45, which would be roughly where the mouse is right now, around this area, just before the breakout, the contract price around that area was roughly $30 per contract, 0.30. When I'm looking at these week ofs, I'm never in a rush to catch a move that I missed because my entry that I was waiting for never hit. My limit never hit. I didn't buy in soon enough before the breakout, so I don't want to chase now. I'm always preparing for that pullback. If a resistance breaks out with buying pressure, I'm patient enough at this point in my trading career that I'm waiting for a better spot to buy in. If you buy in calls at the top here, going off the contract chart, you'd be buying in around $40 to $42 per contract. And that pullback bounced off just above or just at 0.26 per contract. So if you're sized in at 0.4, a normal position size, say you're in $500, you don't want to risk this 500. You're just sizing this your normal size. And can you afford to hold on that pullback if you're down almost 50% on the trade? If with the 0.26 bottom filling in at 0.4, you're roughly down, I'd say just over or just under 40% loss, about 36, 38%. When I tell people this and I show them the visual, I feel like it calms them down. It gives them that relief of, oh, I may have missed the move I wanted, but there's always going to be another opportunity to present itself. And sure enough, if you would have waited for the resistance that broke out just for a recontest, the recontest may not happen. You don't need a play. You're waiting for a play. You're not making a play because, oh, I'm bored. Oh, I missed the initial. I want to catch the pullback. Wait for a zone to pull back. Don't just wait for price to come back down. Don't wait for, oh, the bull flag's forming. I'm going to try and test this and see if I get in. I always wait for the main zones that break the first time. I want to recontest. I want to see it pull back and bounce off what I initially wanted to see break out the first time. Because whatever breaks out after having restrictions before, it's more than likely going to hold on a support bounce if it pulls back to that level again. And even if you would have waited, look at the contract comparison over here. The consolidation at open on Amazon, the contract hit a low of 0.22 if you could have caught that. Compared to that pullback where the orange highlight is, it's only a $4 increase per contract price. Your initial miss that you wanted on the breakout was around 0.28 to 0.3 a contract. So when I show people this, it's like, oh yeah, I can afford just to wait. I don't have to chase this play because a better opportunity could present itself. You never have to force. You never have to buy in because you missed. There's never an idea crossing my mind where it's like, man, I missed a play. You never miss anything with trading. A lot of people, it's like, I missed a 5,000%. Okay, you may have missed it, but prepare yourself for the next one now. Figure out what actually set up in that instinct, in that moment to give you the idea of, I should play this, but I just missed it. A lot of people keep that in the back of their head. Like, this could be that play just like last week that I missed out on. They chase it, and sure enough, it pulls back. They sell early. It bounces right back, and it possibly goes the high of the day from their initial entry point, possibly. So showing the week of, this gives you a very good perspective on when a pullback happens on the week of or 0 DTE for like Friday expirations or SPX with 0 DTE. There's never a rush to get into a play. And the only time you actually will never get a, I don't want to say a better entry, but a safer entry is continuation with no heavy pullbacks. There's no massive breakout on a resistance and a pullback to that as support. It's just trends all day. It's always uptrending, never having a massive pullback to lower the contract prices. Those are the only days where a method like this, you wait for it and it will never present itself. That doesn't mean you didn't have a good day. It doesn't mean you didn't trade. It just means you had no setup that you are favored with probability to win after entry to when you sell. That's how I try and look at stuff. Missing a trade is going to stick with you. It's going to bother you. It may even give you that slight idea of, I remember this setup from last month and I missed it. I want to catch it this time. Nothing's going to happen 100% the same way. And if it does, you prepare for the safest risk. You don't enter off the idea of this could be the same thing as last time. So using the week of, the orange highlight on the contract chart, you can see is basically the bottom of the low on the day off open with Amazon. But going off the Amazon chart, that orange highlight is making higher lows. It's higher than it was at open, obviously, by almost a whole dollar a share. It gives you that satisfaction of I can wait. I don't have to rush knowing this contract could get cheaper from where I originally wanted it before the breakout. If you got it before the breakout happened, are you going to sell at the top or just keep holding? If you would trim on the way up and it has a pullback to this now support that broke out previously as resistance, you can re-enter this contract for a cheaper price than the first time, but size to your liking as if it was going to reject and fail on the downside. You always want to prepare for the worst. And then as it moves in the direction you like, you prepare for the best as it goes. I never personally like to have that, oh, this is going to go to 100% when I enter. Because then if it goes down 20% and I'm not prepared for that, how is my brain and my mindset going to readjust in the moment of seeing I'm red? Not the idea of beforehand. If this level doesn't hold, I'm going to be red 20% if it drops to this specific area. I'm trying to predict, I'm trying to calm myself before entering, because at the end of the day, at that point, if I follow a system, I technically never lose a trade because I prepared for that exact situation. I sold when I said I would. I sized for zero and it didn't affect me because I was prepared. That's the main focal point with correlation of, for me, the mirror of the stock price and the contract price. So I'm gonna take this one away and pull up next week for Amazon. So as I do these, we're adding time to the contracts, and you should be able to see the more time you have, it doesn't fluctuate off a pullback as heavy as a 0 DTE or the week of. You have more time for the stock to make its move, for the contract to move with it. So it's going to be more of a mirror image with the time you add for expiration. So going off the next week expiration for Amazon with this, or actually, wait, is this the 14? That's this week, correct? So this is, oh, so this is the week of Amazon at the money. I clicked the wrong picture. So this example is the same expiration as the last example, but this is right at the money to show you if you size, like I said, the other contract was 105 call. It was $5 out of the money practically for Amazon to hit 105, your contract would be in the money. This example is going to show you sizing at the money. This is an $100 contract premium for Amazon. The price at open was roughly $100. So you're playing right at the money, or for this pullback, you're going to be one slot in the money with this Amazon premium. And the reason I had this pulled up, I'm sorry I messed up this earlier with the title of it, but the week of for the 100 call, you're playing right at the money. The theta is going to be less. The price of the contract will be more. You have an advantage and you're sizing heavier, but the move will not be as massive if you are wrong, or if it consolidates, your contract won't burn in value only because you're right at the money. The contract is holding its value due to the fact that you're already priced into the actual price action of the stock. So just looking at the orange highlight with the horizontal line on the contract chart, you can see more of a mirrored image with the Amazon setup for the actual stock compared to this contract. Since we're at the money, there's no heavy pullback on the price of Amazon, and the contract just totally floods out the gate because there's no IV holding it up. There is so much sellers, it's out of the money. The probability of it hitting in the money is way less, having an 105 premium call price. So focused on this at the money, you're obviously going to be paying $192 per contract at that support pullback. The only difference with this is you can predetermine a loss. If you're focused on the red support, which I put that there at open just for a resemblance, I can say, when looking at that on the other side, that red support is 1.75. So focused on just this idea, I know it's already happened past the chart forming. This is something that you would figure out, or how I figure out in the moment with, okay, if we break this level on Amazon, I personally feel that we're going to have a downtrend, lower highs are going to form. I don't want to risk to hold this contract. The only logical thing that I would do, if we break the orange after I enter at 1.92, my sell knowingly already is 1.75. So I'm risking $17 per contract if I'm wrong on my entry point. So right away, I know if I size 10 contracts, I'm risking 170 bucks if I follow my plan to sell. Say my risk is this other option, this other mindset standpoint. If we break this orange support and we bounce off the red and push back up, I'll sell my position at break even if we recontest this now resistance. We're going to actually reject that now. We're going to respect that level since we're below it for price action and now acts as a resistance. That's where it comes into personal opinion. Are you willing to risk playing 5 slots out the money with the week of, knowing if this consolidates right at this $100.45 a share level, my 105 call is going to burn in value, even though it's holding price action on the stock share. If I play the $100 call on Amazon, which is right at the money, you can picture a mirror image of, okay, if Amazon's stock price drops to this point, the contract's going to follow because it's more of a mirror image when it's right at the money. I'm calculating my risk before entering. I know ahead of time with this example, I'm risking $17 a contract. If I know from my personal belief, I can risk, let's say $500 a position. If I size 10 contracts, which would be $1,920 for the 1.92 a piece, if I sell at that break of the 99.96 per share on Amazon, I would be selling at 1.75 on the contract chart. I know right away if I follow that plan, I'm risking $170. 10 contracts, $17 a piece for a loss, $170. If I can risk an extra 100, I can hold if that level breaks, knowing there's going to be buying pressure on the stock price. And I know the low on the day for the contract's 1.58. If I sell at the low on the day on the Amazon stock, it will more than likely drop below the low on the day for the contract. I can picture this in my head. I'm going off this mirror image, analyzing what's going to happen before I even enter. I'm looking at this when Amazon's up here at 101.30 a share, waiting for this pullback. I'm predicting this pullback to be anywhere in an area from 1.90 to 1.95. So this whole, like, it's a lot to, I don't want to say take in, but it's a lot of preparation that a lot of people don't want to put the effort into. They'd rather just enter a play and, oh, I'm down 20%, I have to get out. When I play stuff like this, I'm playing a system, I'm playing zones, I'm playing support, resistance, trend lines, supply, demand. I'm working with probability. I'm not just entering a play because it looks good and, oh, I'm risking 20%. When you sell at 20%, are you selling at a heavy support zone that could bounce? Are you selling at low on the day that could be a double bottom and it could push back up? A lot of people just want to get out because the percent gains, percent loss, the money gains, the money loss. Trimming is fine in those instances, but I feel you don't learn much when you sell or buy just off, oh, I'm down 35%, I have to get out. If you prepare before entering, you can map out the risk in a play if you size this specific amount. For this example, like I was saying, if your risk is $500, you already know ahead of time, if I size 10 contracts and I get filled at 1.92, my risk is going to be $170 at 1.75. I want to risk 500 though. If I double my position, get 20 contracts at 1.92, my risk is now $340 if I sell at my conviction of 1.75. It's all about readjusting. You have to follow the system for yourself to be content with the results. Because once you have that idea in your head of my risk is $170 for 10 contracts, if we do bounce here, all I needed to do is break $17 in profit per contract. My reward is higher than my risk. So you don't have to prepare for the reward, but looking at this from my perspective, if we can test that high double top that happened, then we came back to this $100.45 support zone on Amazon stock. If we break back up to that area and we bounce like we did, obviously, that contract will be worth just under $250 a piece. So you're making $50 a contract. Your size 10 contracts, you just made $500. Your initial risk total was 500, but going off this system, you're risking 170. Risk was 170, sell for a double top high of the day, $500 profit. Risk to reward right there is about a 1 to 3, 1 to 4. So I'm calculating this stuff ahead of time. I like to play at the money. I like to give stocks a few months or a few weeks of time. And that's the example I'll pull up now is Amazon's chart for a month out. That's what this one's going to be. So there's going to be less volume, obviously, but I still chose the best contract, which was the Amazon 105, the May monthly. This had enough volume to buy in and out, but compared to the week of, the following week, at the money, week of, 5 slots out, week of, you're not going to get as much volatility because they cost more. The contracts are more expensive because you're adding time. There's less risk, though. That's the biggest reason I like doing stuff like this when I size heavy. If I size $5,000 worth. If this, like, we're only focused on Amazon's chart right now. If we get that pullback to that red support at 99.96, going off this month out of the 105 call for Amazon, you're risking 17 a contract once again. But here's the catch. You're risking 17 a contract. This one cost 387 a piece. The one previously was, what was it? 196, 192. So you're risking double to only lose the same price for this. So basically, 3.87 is your entry. Your risk is 3.7. Right away, you know you're risking $17 a contract. It moves slow. You'll have time to hold this even longer because you have a month out expiration. The push on the reward is not going to be as rewarding as the week of right at the money. The risk is higher though. You're paying less to risk more. For this one, you're risking more, but losing less. So percent wise, you're saving money when you play a $17 loss on a $387 contract. You're not going to make 500% a day, 50% in a day. If the move is big enough, you will make 50% off of the monthlies. But this is safe. It's easy to learn. You have a mirror image, literally, when you play a month out expiration. A lot of people, they want that quick money. They want that 100% in a few hours. They want that 20% in one candle. That's fine. But when you're only looking at the reward with a play, you tend to forget about what you're risking to get to that point. A lot of people just want to get the money. They just want to buy in and make 30% quick, not knowing just as fast as you make 30%, you can lose 30%. Maybe the stock on the 0 DTE, it just consolidates and you're losing value, even though the stock price on the chart is holding value. It's showing you strength that you can't sell yet, but you're losing value on the contract. It's a huge emotional drain for me personally. And that's why I tend to fade away from size and heavy on week ofs. I'd rather give it time, size heavier on the monthlies, 2 weeks out, 3 weeks out. Because if I size 10,000, say I size 10 contracts on the monthly for the 105 call, as we've seen Amazon recently, we pushed after the start of this week, we pulled back, now we're pushing again. If I would have sized 10 contracts, right away, I know my risk is going to be $170 because the risk per contract is 17. If I can swing this off of momentum, even if like you see how Amazon held consolidation at the 101.86 area on the high of the day right here. Look at the mirror image with playing the month out. There was no heavy drop on the contract, even though it was consolidating. It held value. It has time. You can play the chart and not have to worry about, oh, Amazon is down 20%, but the stock is still holding. My contract's down 20%, but the stock is still holding. Playing time gives you patience. It gives you that conviction to play the actual stock chart, to follow the movements, follow the zones. You're not going to get rewarded as heavy, but you're going to be in the game longer. You're going to last as a trader longer because you're risking more money, but it's way less of a risk because you're not going to lose this whole position in 2 days. It's literally impossible. For you to lose this, it would have to drop $20, $30 in a day, and your contract would probably be around $20 a piece. Stocks that you play and you're familiar with, you're not going to be intrigued or very scared knowing, oh, I've never seen Amazon drop intraday $10 in a day, $5 in a day. It's rare that it happens, and it can. But if that does happen and you're in calls and it starts to drop, you have a sell point. You're prepared for the worst, no matter what happens, even before you buy into this contract. So many people I show this to, it's like, oh, that's so nice. Like it's patient. The stock holds. My contract's not losing value. It's like trading futures. You're trading the zones off the actual index chart, stock chart, whatever it is with correlation to your contract. People lose sight of this because they get an amazing entry. Say Amazon pushes $1.50, $2 upside, you'll only make about $100 a contract, $80 a contract. It's not a lot, and I get that, but your risk is so small for sizing this much. If you catch the continuation, trim as it goes up, if Amazon holds these levels and you have a stop loss at say 400 a contract, so you're guaranteed $13 profit with that stop loss. The actual Amazon chart has to pull back to that area, to that zone that links and mirrors that actual 4.0 on the contract chart. So basically for Amazon to stop you out, if you were to stop sell limit at 4.0, it would have to drop back to about $170 170 cents a share. 180 cents a share. It didn't do that. It consolidated and tried to push into the day. Obviously, the next day the pullback happened, but we're focused on this exact example. This day of the way it's moving so slow, it's patient. It gives you time to learn the actual chart setups. You're not scared, oh, I'm down 50%, but I haven't sold because my support's still holding. Something like this, your support's going to be holding, you're down 5%, you're down 4%. Slowly it gains momentum. The contract's not going to sit. It's going to slowly move upside with the actual price action of the stock. You'll be up 5%, 10%. At that point, stop loss at 5%. You need a massive pullback for calls when you play a month out or 2 months out. You're sizing more, the risk is less though. That's why I personally will do this when I size heavy. And now I'm going to pull up SPX. Let's do the week of first. I'm trying to get examples of multiple perspectives before I just start like talking more about this, because I really want like you guys to understand the visual side of a regular stock SPX on 0 DTE plus a week out, or just a massive stock you're playing a year out or a few months out. So you get the idea. Your trading style may adjust to one of these. You personally may see this and say, I hate fast movements. I have money to size, but I don't want to pay $700 on a $100 contract. Like buy 7 at $100 a piece, you're paying $700. Because then if you're wrong, 30% down, right away you're losing $210. So it's all about your comfortability, how you see your personality and what you can adjust to and be content with. The system of adding time is very draining for people that want stuff quick. Like they just want it. They want it. They want it. What do you want if you can't keep it? Like, what is there to have if you can't keep it? A lot of these people that trade the day of, the week of, they hit a few times and they lose the money. They know how to make money. They can't preserve the money. They can't secure the money. They can't pay themselves. I like to give people an option to see the broader view of adding time, or at least playing at the money with this system. There's so many different ideas you can have with this, a lot of different methods, but showing you vast varieties of at least 2 to 3 stocks and their examples, and may open your eyes to realize, dang, like I'm risking this much when I can't afford financially to do this. For the next few months, I may need to play extra time on my expirations to give myself that breathing room, to give myself time to see the chart move. I know a drop's coming. It may not happen this week. Oh, but I want to make quick percent gains if I miss it. Why not just lower your risk and just size heavier for 2 to 3 weeks out or a month out expiration? You have all control when you trade. No one's telling you you have to sell right now. You have to buy right now. People may give you their opinions. End of the day, it's all you. You buy in because of you. You saw someone alert something. You didn't look at the chart. You bought in blindly. That's because of you. I like to know everything ahead of time. My risk, my possible reward, a zone that I have to wait for. Going off this SPX, this was a 0 DTE play, 4,100 calls on the right side. So as you can see, this rising wedge on the actual SPX chart, I put a few white highlights, rectangles, just to show you the higher lows that are forming. When we come over to the 4,100, even though SPX was trailing upside, from the low, it was at 40.72. At the high, it was roughly 40.90. So from the high to the low, it pushed about $18 up, like $18 per share or per price on SPX. The 4,100 call, even though at the high of this, it was just under $10 out of the money. Look at this zone. It's not even showing higher lows, slightly, but it's nothing like the actual chart of SPX. A lot of people think I have to chase this. Like they missed this first yellow rectangle, or the white rectangle right here. They missed that and they chase it halfway up. If we take that correlation of that second rectangle, if you would have chased this halfway up, you would have got in roughly in the middle of this consolidation. The bottom of that was roughly 157 per contract. If you would have chased it, you've been paying an extra $50 for roughly 200 a contract. Obviously, it ran upside about 30%, 40%. But if you're looking for that bigger move, even though SPX on the stock chart is looking, or the index chart, it's looking amazing. Up, it's higher highs, higher lows. It's showing you direction, and you're like, I'm going to hold because the breakout's coming. The value of that contract is sitting. You're not making money even though the price of the index of SPX is moving upside with higher lows, higher highs. Once that pullback happened on this stock or the index, the contract dropped to a low of 0.65. So I'm always telling people, what are you really missing? If this continues to run upside with no pullback, obviously you're looking back at it, oh, I should have bought sooner. I don't care about, oh, I missed the play. What are you missing? The pullback happens. The contract's at 0.65 now. At that point, a lot of people are like, oh, it's going to be downside now. I don't want to buy this contract. I'm always focused on a new support forming on the larger frames. Once this new support hit and then we bounced, now we're making on the extended frames higher lows, not just the 1 minute, the 5 minute, the 10 minute. We're making higher lows on the larger frames for this staircase to continue upside. So many people that I've tried helping, even that I help now, when they see massive red candles, the first instinct is this is going to keep dropping. We failed the index chart of this rising wedge. We broke the downside of the support trend. We're going to keep tanking. My first thought, I'm getting a discount on these calls. I'm getting a discount on calls in general. I missed my put entry, which was the high. I'm always focused on the best low risk entry. I'm not buying calls on this breakdown because I have a support zone. I'm going to respect my zone, my TA, and I'm going to stick to what I hope is going to happen. I'm playing a system. There's no risk when you play a system. You know the risk. When I'm sizing, say you enter at the low on the day for this contract at 0.65. You size one contract, you're risking 650 bucks. I mean, you're risking 60 bucks, 65 bucks. Are you selling at 50%? Are you going to sell if SPX breaks low on the day? That's where you personally have to think that through. As this is breaking on the downside, you're preparing. You're trying to figure out what's the best price per contract. For me, I'm not going to try and predict the bottom. I'm going to wait for a bottom to bounce off my level and slowly make its way back up. I'll enter this contract light and let it work its way off my zone. The average entry on this for what I usually look for, I'd probably get a 0.85, 0.9. I'm not going to say I'd fill 0.65. It's likely. I don't expect it. I'm not expecting 0.4, 0.3, 0.5. I'm looking at the price once I get my zone touched on the actual index or stock that I'm looking at. Once SPX touched, you have to realize the IV is limited. People are selling this contract. It's going to be cheaper than what it is when it pushes back up. So once it started to gain that momentum, I'm looking at, okay, we touched my 40.75 level for support. What's the contract at? Okay, contract hit a low of 0.65. We're slowly turning upside. As we're pushing this heavy on SPX, the actual contract is slowly zoning its way up. So you're not in a rush to make a play. You're maybe going to miss out on an extra $15 entry. That's less risk. The biggest thing I tell people, don't chase when there's a better move coming. This pullback was the better move. Even if you fill it $1, 1.2, 1.3, it's still cheaper than the contract triple bottom, aka the higher lows on this rising wedge. You're still paying less, even though SPX is more expensive price per share. That is so important to realize. There's no exception as to why you should think, I don't want to play this now. You wanted to buy it at 1.5, now it's 0.65. Why don't you want to buy it? Trends are holding. The index is literally still formatting what it has to go upside more. There's no point in saying, oh, I wanted it at 1.5, now it's 0.7. That's too cheap. I don't want to risk that. There's no difference. If you bought in a contract at 1.5, say you're risking 50%, which is 75 bucks. If you size one contract at 75 bucks at this low, size for zero, buy one. If you would have done that and held for this breakout, that one contract worth 70 bucks would have ran to high $400 a contract. You could have sold at 300 at this push. There was no pullbacks to make you get scared out of this. The only pullback was back down to like 280. Your entry was 0.7. There's literally no risk with this trade because you're expecting zero. If you can size a $150 contract and hold that down 50%, you should be able to buy one contract worth 70 bucks, 60 bucks. You can hold that to zero because the reward, if the support holds the way it does, obviously this breakout was not expected like it was. It happened. Looking back, it should prepare you and make you learn for another scenario that could happen. Don't expect the same move, but play the zone, play the system. Memorize this setup of a rising wedge that breaks down. holds a major support, bounces off it, wicks below, pulls back up, your entry is going to be cheaper than where you originally wanted that rising wedge. That is the only thing I try and focus on. If I get a cheaper entry, I'm sizing less, which means I can hold it to zero. If I'm paying 150 a contract over here and we dip down when I'm still in that contract, am I just going to hold that one contract? And am I going to average in since my support on the index is now touching? That's when you start thinking. That's when you finally analyze who you are, journal what you felt during the trade. You grow as you watch stuff. You grow as you hold a position. You grow as you lose money, as you make money, as you find a system that doesn't work right away. Something has to work eventually. It's not just, oh, I'm losing, it's not working. You're not going to win every time. There's going to be cold streaks. You'll lose 10 trades in a row playing the system that last month may have gave you 7 wins in a row. It doesn't mean you're losing. It just means the system and probability is not in your favor at the time. Recently, the market's been tough. Systems aren't aligning for most people. Plays aren't working out at open for most people. Plays are at the end of the day. A lot of people don't trade end of the day, so they can't trade this market right now. They don't have the time because that's not their system. People know what to look for because they know who they are as a trader. They know their emotions. If they miss a play, they may just be done for the day. It's all about how you perceive trading, how you perceive your time into this, the time at which you can trade. You have to figure out who you are and use expirations for your favor. Use contract price for your favor. Can you play at the money and afford to pay more for a lower risk due to the fact that if a pullback happens, your risk is going to be less for the more you're paying. Even though if you're sizing $200, you're going to lose 17 compared to sizing 400, losing 17. You're risking more percent wise when you pay less for a contract and you're losing the same dollar value per contract. So I try and show people this. I'm going to keep saying show people, reiterate them with a better perspective or a new perspective. The only thing that you have to do when you trade, there's no competition. There's no end result of I have to make this much money. We're all just trying to survive. We are literally trying to make ends meet and grow our accounts, secure our accounts, make money long term. If you don't have a rush to make money, you shouldn't play zero DTE. You shouldn't play week of. You should grow with your account and learn how to play the chart. Learn the zones, learn the correlation with one stock with a contract price action. Figure it out so you have that edge in your favor. If that's who you are, you may only need SPX 0 DTE. You have to be patient and wait for stuff like this. When you play the 4100 call, the support zone was roughly $25 or 25 points out of the money. It's a low risk due to the fact the contract's only $65 at the low. If you do end up playing this same setup for the week of SPX at the money, this is when I tell people, okay, this is how I like to trade. This is personally how I like to do it. I like to play at the money SPX. This right side of the contract chart, this is the 4080 call. So the low support bounce was 4075. This was one slot out the money from this support bounce. One slot out the money. You're going to pay on average $540 for this at the low. This example, you're paying $540 a contract. A lot of people can't afford that. That should give you the indication. You can't play at the money SPX if it's too much for your account. That's when you have to size down into Amazon or Apple or other stocks that are cheap. American Airlines, Ford, DraftKings, XOM, ExxonMobil. You have to find a system that fits your account, that fits your position size, that fits your emotions, that fits your time schedule. You are adjusting you for a system you're going to make. Seeing different perspectives like this will give you an idea of like, okay, I like to hold and play the chart. And I hate when I'm holding a chart that's looking strong, but my contract's dropping in value. I can't deal with that. Maybe you should add time to your contracts. It will lower your risk. It will lower your emotions. So just going off this at the money SPX call, literally is $5 out of the money. So if we get a $5 push off this low, once we enter the contract, we are in the money once 4080 passes on SPX. So at that point, as long as the consolidation hold on the index of SPX, as long as the uptrends continue, you're in the money. Look at the correlation with this high of the day. It's literally a pinpoint of the chart to the option contract because you're in the money at this point, $20 in the money, $15 in the money at the lows. There's no concern and you're able to hold if you want to. If you get to the point of this small bull flag on the 1 minute, it breaks out, your risk for a stop loss is going to be a break on the low of the bull flag, which would be roughly 40.92 per price action or 40.92.50 on SPX. That will correlate to about 1,500 a contract as your stop loss. At that point, when you have this stop loss in, you know for a fact you are guaranteed $1,000 a contract profit. Hopefully that makes sense. Once you have a stop loss in, your entry to that stop loss, you are guaranteed that profit. When you're in the money, there's no stress. As long as the stock or index holds a position at consolidation when you're in the money that much, I mean, 20 points in the money is huge. It's going to hold value. That contract's holding value unless you have a major sell-off. But at that point, it's catching up to the actual price action on SPX. So using this purple, I wanted to give a good visual analysis of 4097. Obviously, it's 4096.97, but we're going to round it up. So 4097 is this purple highlight. When we pull that over to the contract chart, look at the correlation with how similar that looks. We have this bottom trend line here on the index for SPX. We have this bottom trend on the actual contract. This is a mere split image because you're in the money so much. You're paying more. It's not 65 bucks at the low. It's 540. I get that. But if your account can allow you to size one contract, you know right away, if this rejects the low on the day, I'm going to be risking roughly 80 buck loss, $100 loss on this contract. The upside for reward is going to be greater from a money perspective, but the percent will not be as heavy as sizing the 4,100 day of. You're playing 25 slots out, so you need a bigger move. But if consolidation hits along the way, that 4,100 is going to lose value so quick while this contract holds value, and you can hold based off SPX chart and not just the contract of you wanting more money out of it. So I'm going to pull back up the 4,100. Look at the end of the day. We have this purple highlight on the actual SPX. Here's the purple highlight on the 4,100. This is the correlation I like to show people. You have the 4,100. It's at 266 on the right side. That was the high of this rising wedge for the contract price. But going off the index, that's a $10 higher price per point on SPX. 10 points higher, but the contract's still $4 out of the money. It's not going to hold value like the 4080s is. The correlation with this is so clean when you play at the money. You have to pay more, but you're playing the chart more of a mirror image. That's what this whole, I don't want to say class, but this whole lesson's about is the advantage you can have playing at the money. You pay more, the risk is less because you're playing a chart. There's no hesitation you're not prepared for. When you play a chart, you expect zones to hit. You expect trends to hold. You're watching the volume come in. You don't expect consolidation to hold for a certain time frame, then push back upside. When you play at the money contracts, once you're in the money and that consolidation hits, you're not risking as much. You're going to be safer. The IV is not going to kick in. The delta is not going to destroy you on a pullback. When you're out of the money for like the 4,100s, there you go. When you're out of the money for this and it's pushing upside and consolidates, SPX is forming a rising wedge on the high of the day. This is literally losing value to the end of the day only because it's not pushing fast. It's holding, it's consolidating. The price action on the contract's coming down, but just looking at SPX right here, oh my gosh, like we're holding trends. I don't want to sell my 4,100 yet. What if this never breaks out like it actually did? If this would have kept consolidating around 40.96, 40.98, by close, this would have been $0. When you're focused on at the money and you're at the end of the day, you're in the money 20 points, 15 points, 10 points. You can afford to hold because you know if the trends hold, if the uptrend keeps going, you're safe. You entered with more money for the contract, but you're safer if you're right and you get in the money. If people can afford to buy 10 contracts at 0.7, they can afford one contract at 5.4 or 6.00. It's all about your personal emotions. Can you hold through red? Can you hold through consolidation, even though for your contract to get in the money or to gain that IV push, you need a 5-point push before a set time frame, or you need a heavy break above this resistance, but it's rejecting, and now your contract that's out of the money is losing value. If you're playing at the money or if you're already in the money, a rejection is not going to hurt you as bad. It's not going to scare you if you're focused on, oh, I just lost 25% of my 50% gain. You're focused on the chart's holding. I don't have to sell yet. I'm not worried. I'll put a stop loss if the stock breaks below 40.93. I'll get out at that point. I'll find the correlation on the contract chart. If we have that pullback on the break of trends, if the trends break, my stop loss will hit. It's not the fact of, oh, I just want to sell to get out. If you want to sell for profit, be my guest. You just made money, you're done. A lot of people like to see the runners go. They want to trim and leave some with a stop loss. Playing at the money or in the money, you're guaranteed to make your own exit based off the actual SPX index or the stock you're watching. When I pull up SPX 2 days out now, the biggest thing about this is they're going to be way more expensive. SPX 2 days out, this is not 0 DTE. It's not the next day. It's the following day after the 1 day out. The mirror is going to be way better. Obviously, the low on this contract's the low on the day for the contract, and we're still holding high. I mean, we're still holding lows on this support for SPX. But the contract, when you're this far in the money or playing time, they're the same. If you have extra time on an expiration and you're playing 25 slots out, because this contract is the 4,100 for a 2 day out expiration, 2 days out, playing 25 points out the 4,100, it's the same thing as playing at the money for 0 DTE. The only difference is you're going to pay more money because you have more time. You're able to hold this in a loss because a pullback may happen the next day or the next day. Paying 1,500 a contract is a lot. I get that. But your risk putting in 1,500 may only be $100. If you play the other contract, which would be, oh geez, where'd it go? This one. Why is it coming up? What's going on? There we go. So if we play this SPX, the 4,100 week, the day of, 4,100 day of, say you want to size 2,000, just like how you would on this SPX. You buy one contract for 1,500, or let's say you buy this contract at 1,600, and then this at 0.7, you buy 20 of them, which is 1,400. The biggest thing I tell people, if you're down 10% on this, that's a 0.07 drop on a $70 contract. If you drop 10% on this contract, on this contract, that's 1 point for a $1,600 contract. That's 1.6 you have to drop for a 10% loss. I'm pretty sure you're going to sell well before a 1.6 drop on this contract. But going off the contract that's 65 cents, why is this never popping up? Going off a contract that's 65 cents, the biggest issue is one little hesitation, one little pullback on this stock of SPX. This contract's losing more than 10%. Hopefully that makes sense. When you're playing 25 slots out of the money on 0 DTE and this stock consolidates or it drops 2 points before going back up, your risk is so exponential that a slight drop, even though trends are still holding, that 0.7 entry could easily go down to 0.5. You're down 30%, just like that. There's no getting around it. If you're playing a contract that's 2 days out, yes, you're paying 1,500 for one contract, 1,600 for one contract. A 30% loss on this, do you know how much this has to drop before you sell to lose $300 on this contract? It's safer. Your reward will not be as big, but you are facing the chart and holding based off the chart. You're not holding off, oh, I'm red 20%, I have to get out. You're holding off the fact of this chart's holding. I'm not going to sell down 20% because we haven't broken the trend yet. I have 2 days left on this SPX. I'm only down $200. If that same situation would happen with a 0 DTE of the 4,100, you could be down 50% size in 2,000. You're down $1,000. For this one, your size 500 less, you're only down $200. The risk is smaller, which makes the reward smaller, but you're able to hold through consolidation. You're able to hold through a fake drop after you got calls. This is one of the hardest decisions I had to make as I made my trading account bigger, as I traded more fluently with money per position size. I would get wicked out on size and heavy for 0 DTE or playing the week of, I had to readjust and figure out if I'm not capable of holding down 30%, I don't deserve to size the way that I am. If I can't hold past 50%, even though trends are still holding, I don't deserve to size that heavy. I have to learn to hold more and play a chart before I just size $2,000. I'm down 50%. I got to get out. My risk is way too heavy if I'm risking $1,000 on a $2,000 position. So as you work your way into playing different ideas, playing different contracts, adding 2 days of SPX while playing the same contract premium of the 4,100, you'll pay more per contract. Yes, I get it, but the risk is so much lower and you can hold through the turmoil. You can hold trends and you'll make money once you're in, like as it builds to where you need it, you can afford to hold because the trends are going to hold. Everything's going to hold value. Contract's going to hold value. This one contract, if you were to buy here, sell at the rise and wedge at high of the day, you can make $1,000 a contract. The risk is small. You can hold through this run up. You're not scared of a pullback because a pullback's not going to do much damage to your contract. On the other hand, though, playing this 4,100 the week of, one little pullback like what happened right here, it was a bull flag that was showing strength. This contract had a massive pullback, push back up, massive pullback, push back up. The emotions right there, just me seeing that contract being at 450, back down to 320, back up to 400, back down to 340. You're moving 30%, 40% in seconds, in minutes. I don't like to deal with that when I'm size 20 contracts. You're fluctuating between a $2,000 gain and then only being up 1,500 within a minute. Instead of having a contract like the one I was talking about, it's more expensive, but a pullback here, there was no pullback. It just held exactly like SPX was holding. It's all about what do you want to deal with. A lot of people, like me included, I'd rather play Amazon or Apple month expiration. I would not play SPX 2 days out because it's not worth it for me. I'd rather size $500 for a safe risk to make 20% back than risk this much. And then it's this one contract position. I like to trim. I like to leave a stop loss. I don't want to size over 3,000 a position. I don't want to size over 5,000 a position. So as my account gets bigger, as I'm more confident in who I am as a trader, I can play this setup with this type of expiration and this strike price, and I don't have to worry. So I'm going to pull up the last example I have, which is Apple. We're going to start with the week of out of the money, a few slots out. So here with Apple, it was practically the same setup as Amazon had this same day. We had a massive sell-off at open. We held a double bottom, which I put a level at for the 160 a share. We held a resistance zone of support and resistance at open for about 40 minutes straight, an hour straight. It was just up, down, double bottom, back up, consolidation, push above finally. Once we broke out of that 160-60 area, I'm waiting for the pullback. I'm waiting for that previous resistance to now act as support. If we don't pull back to this zone, I'll readjust as the higher lows form on this chart. Obviously, we had a nice head and shoulder forming, the inverse head and shoulder. So we're focused on, if this pulls back and curls, we could form this right shoulder. I'm looking at patterns forming while looking at my zone. So just going off this 165 call, this drop was at $160.60 a share. You're playing 5 points out of the money. Since Apple's contracts are every $2.50, you're basically playing 2 to 3 slots out the money for this contract. At that low, if you caught it, it would be $38 a contract. Say, like I was saying with Amazon, you missed the initial drop off at open and it pushed back up. Say you missed this breakout and you chase it. The opportunity that you're missing, it's coming. Obviously, it may not have pulled back in the moment, but looking back now, this should give you that conviction of, do I want to chase or would I rather wait and see if I get a pullback for a cheaper price where I have control over my risk and my reward? Buying this breakout, you don't know how high it's going to go. You don't know how low it's going to pull back. And if it does pull back, if it goes back into the red for your position, can you hold through red? That's the biggest issue a lot of people have. Going off this example, low on the day for Apple was 35 cents per contract, $35. That pullback support at the 160.60 per share, it was an extra $3 you're paying. So what did you really miss after seeing this setup? $3 a contract entry point. That's not worth chasing this position and try and make an extra few bucks. I'd rather wait and see it form. And sure enough, once that pullback hit, it broke out upside. Before I switch over to the week of Apple at the money, focus on this white highlight, this double top on the share price. Notice how that did not happen on the contract price. Since we're so far out the money, a little consolidation or a hesitation to keep breaking upside, the contract will not hold value historically like it does on this chart because you're playing a 5-point move out of the money for Apple. So now I'm going to pull up week of at the money. And here's a little bit of a better example now. So this is the 162.5 call. This is right outside of the money for Apple. As Apple pushed the high of the day, it almost contested that actual in the money to put the contract in the money for the value. Low on the day for this contract was 0.97, so $97 a piece. That pullback was $106 a piece. Going off this example, you can see how the extension of the correlation is not as spread out. It's a lot more of a mirrored image since you're playing one step closer in the money than the 165 call. Going off this pullback, you're focused on, okay, this rejection. We try to push back up, failed. Try to push back up, failed. I'm looking at a pullback once we break that resistance. I'm looking for it to hold support now when it does pull back, if it pulls back. You're not missing any price per share or price per contract if you don't buy before the breakout initially happens. If you do catch the breakout, where are you selling? What's your hopes on this play? When you get that pullback, you know right away, if this support fails, I have one more support zone. Going off the contract chart, I'll be risking just around $10 a contract for a loss. So I know ahead of time, if I get this pullback to this $160 a share and 60 cents, I know right away if I fill roughly around the $105 a contract, $108 a contract, I'm risking roughly $10 per contract. I'm not even filled yet, and I know my risk. So when this does happen, right away, the risk is lowered. We're making higher lows on the larger frames. If you switch to the 5-minute or the 15, you're going to see this trend holding. You have conviction to hold now. You're not buying in before the breakout, then it breaks back down. You're not red on the play. You're entering at the next possible trend or support bounce. That's putting probability in your favor. And then sure enough, as this contract gained value, it ran almost 50% from where your entry would have been. You could have bought the open. I get that. But what if you would have sold at the high of this contract? A lot of people get discouraged because, oh, I could have held for the end of the day and it was higher than where I sold. You would have had to have held this contract. If you entered at 1.2, it would have been down roughly 20% from where you could have entered in. Obviously, it's about a 10% red trade if you would have bought in sooner before the breakout, and then that dip would have happened. I'm always focused on low risk, high reward. I don't care about catching the play I missed. I don't care about, oh, I missed it, I have to do better next time. I'm only focused on the bigger picture. So now I'm going to look at Apple next week. So it's a week out in the money contract. So this is going to be the 162.5. It's one slot out. So as it pushes upside, the contract will slowly flip to in the money. So you can see a perspective of a week out expiration. So just like the previous one, right away, you can actually calculate and find a determining factor of where is the support going to hit. We're looking at this resistance on Apple, that $160.60 a share. You're using that zone as confirmation. I know I keep saying this, but I want to reiterate before I get into the actual contract for this. You're waiting for this resistance break to now flip to support and hold that buying pressure if we dip back down. You want to see buyers take this over and push it back upside. You're getting lower risk off this contract. You'll get a cheaper price for more risk management in your favor. You know the low on the day for the contract is now 1.78. Your entry is going to be around 190 to 200 a contract. Right away, you know I'm risking $20 a contract, $25 a contract. Instantly, you know this. There's no emotions. If you know this and you're saying, I can't afford that much per contract, you don't enter. That's all it is. You have to figure out from your emotional standpoint as a trader, can I risk a $20 loss on a $200 contract? Can I risk a 10% loss on this contract? Sure enough, as this held value, just like the previous examples, It started to uptrend. As it gets closer to in the money, this contract will hold value and mirror this stock chart. There's no consolidation and the contract drops in value. You have a week of time and you're basically right at the money as the high are pushing back up again. I'm going to pull up one more example. I'm going to play, it's going to be Apple again. I know it's getting boring, but I'm trying to show multiple perspectives. I'm teaching for people to learn something they may not have known about, may not have been able to comprehend before. Maybe they just figured out, holy crap, I can look at a contract chart. I never knew I could look at a contract chart. I'm showing you multiple perspectives because a lot of people, they don't understand visual risk until they're in a play. And by then it makes no sense. They're just holding because they want to hold. They're just waiting for a play to form because they're following someone else. They don't even know what the heck's going on. So showing you these month out expirations, these week of at the money, week of 2 slots out the money, you're getting an idea of how high a risk is, and you can actually control what contract you buy, how much you put in, and you'll know how much you're going to lose per contract before you even enter if you calculate the risk that comes with a level you want to enter on. Playing this Apple contract, you're playing a month out, you're playing the 165 call. So when we're looking at the month out 165 call, the week of contract is obviously going to be way cheaper. The 165 call for Apple week of, that's what this contract chart is right now. You can see a drop to low on the day is $3 a contract. That's a 10% drop. 0.38 to 0.35. That's basically a 10% drop, 0.03 on the contract. When we're focused on the month out expiration of Apple, our drop from entry point to low on the day is 4.20 down to 4.05. Not even a 5% loss on this contract if Apple breaks low on the day. Right away, you know, I'm not even risking 10% per contract. If I size $4,000, I'm risking $400. I'm risking $200. Right away, you know this. If you size on the week of Apple, let's say $4,000, you'd be buying roughly 100 contracts. If you get to low on the day, if the value holds at 0.35, if you can even get out at 0.35, you may be selling at 0.34, 0.33. Every 0.01 move on this contract with 100 contracts, you're making or losing $100. So think about the emotions as this drops to low on the day. If a huge red candle hits on the way down, I guarantee you this contract at the low for the Apple stock price is going to be 0.3 for the contract. You're going to be down $800. Going off the monthly, the risk is so minimal. The reward is going to be less, obviously. You're not going to make a higher percent if it runs in your favor, but you're reducing risk. That's the biggest accolade with doing stuff, with adding expiration time, adding time so you can follow a chart better. This risk is literally $15 a contract. Obviously, if we drop on Apple low on the day, this contract may hit 4.00, 3.90. Even if it hits 3.90, you're not risking 10% of this position. You know the risk already. And this is one system I used to play before Amazon had their split. When I played 3 weeks out, 4 weeks out, I would be paying $6,000 to $7,000 a contract, but I could size 4 contracts, 5 contracts. I was able to size heavy because if I was wrong, my risk of 5% loss, it wasn't as bad as sizing the week of, and then one little tick and I'm down 15%. I want the odds in my favor. Everything I do with trading, I want control so that if I lose, if I win, everything is on me. There's no blaming the market. There's no blaming a signal that I follow. There's no blaming other people. I know before I enter what the risk is. I know what I enter, and I know what the reward could possibly be. I have a visual perspective of this option chart right here. I'm always looking at both the actual stock or index, and I'm looking at the contract I want to buy. I'm calculating. I'm determining where my entry will be way before it ever happens. I'm waiting for zones to form, and then I execute. That's really all this is. Does anyone have any questions or just confusion possibly? I know this was very visual and me just talking, and this was probably like very confusing because a lot of people, they don't actually correlate a contract chart with an actual stock chart. And I think that's one of the biggest issues with people that lose money in trading because they're so focused on the persona of I can make 1,000% in a day, not realizing you can lose 1,000% in a, I mean, you can lose 100% in a day, the whole position. You can swing a position thinking, oh, this is going to be a good investment. This is going to be a good trade. Next thing you know, you're down 50%, but the actual price action is holding. So it's a very, I don't want to say difficult situation to like get accustomed to, but it's all about your risk tolerance. If you have a small account, you obviously can't risk playing a month out expiration for SPX. You can't risk it on Amazon, but you can play a cheaper stock like American Airlines or DraftKings or BAC, Bank of America. You have to find stocks that correlate with your position sizing as you size with more time. If you're able to play zero DTE, you can risk playing SPX like it is on the screen right now. The question is, though, can you comprehend the fact that if you're wrong, your position may go to zero? Your conviction is going to determine everything. Can you hold the zero? Can you hold a position down 80% zero DTE for SPX? And by end of the day, you can be up 400%. Can you size light enough to hold down 80%? Because if you're oversized, you're not going to hold down 80%. And then end of the day comes, oh, if I would have held, I would have made 400%. Your size too heavy. That's where the readjusting comes into play. I size too heavy for this position. I have to look for a better execution standpoint. I have to readjust how I buy a contract. I have to be more patient. I have to calculate my entries before I do it. There's a lot of different misconceptions with this kind of style, and I'm hoping this opens up someone's eyes to realize you can look at a option chart and literally trade that based off the movements. Like, you know, the risk ahead of time. Looking at the actual stock chart, then you can formulate a mirrored image of, oh, if it pulls back to this zone, the contract will roughly be around this price. You can predetermine your sizing. You can predetermine your risk before even entering. I love that. I love the fact that I know my risk before entering. I love the fact that, okay, my risk is going to be 50 a contract. I can size 1,000, but I have to realize if I size 10 contracts on a $50 risk per contract, I'm risking $500. I know that beforehand. Okay, can I risk $500? I don't want to risk that much. Most I want to risk is 200. Okay, well, guess what? I'm going to size $200 and I'll hold the zero. That's all that is for me. If I size 10 contracts and my risk is $200, I have to sell at 20% loss. Love the session, very helpful. Love the idea of buying time within the money contract can improve the trading now by visualizing the risk and reward beforehand. Thanks. You are welcome. I think the hardest thing for people to really come to terms with is they want fast money. And trust me, I get it. I've been in those shoes. I've made a lot of money. Then I've blown ports before trying to do the same thing. It's not going to be as successful as you think. And long term, one win is not going to outweigh 4 losses. It can, but eventually it's going to catch up to you. One major oversize is going to burn your account if you lose on that one. So you have to really time out the sizing, time out the risk, have a visual perspective of, I'd rather play in the money and not risk losing as much because I may not make as much. If you want that long-term perspective in trading, you need to add time to your contracts. It's not like you should. You honestly need to, because long-term wise, it's so hard to lose a whole position if you're sized a month out at the money, or if you're sized at the money week of. The risk is so much more minimal because consolidation isn't going to kill you as bad. If you're in the money on a contract and consolidation hits, you're going to be fine to hold for a little bit. There's no pressure on a position when you're in the money. You feel so much safer. So there's no risk playing at the money because you have the risk of selling percent wise or zone wise on the stock or index. Everything's predetermined. When life is predetermined and it follows suit with like, okay, the risk is this, reward is this, whichever happens, I'm fine with. Imagine that with trading. Imagine the effects of knowing my risk is this, my reward is this. I'm not even scared going into this trade. If you're scared, size less. If you're scared, don't enter. The persona of this should speak volume compared to just seeing, oh, this is cool. This can literally make you a trader long term. Zero DTE is fine. I have nothing against it, but the risk associated for a small account, it can blow your account and not even the money financially, but just blow your mindset. one major loss could just destroy you and not make you want to do this again. 4,200 full port tomorrow, say less. Hey, we may send, who knows? Definitely don't full port, but hey, if you can afford it, be my guest. LMAO. But yeah, like if you guys don't mind responding, like how did you feel about this lesson? How did you feel for you? Like, was this the first time you saw contract charts? Was this the first time you ever saw the correlation of if I add time, literally there's no chop that will kill my contract? I'm hoping something out of this made sense. And if you already knew this, I'm hoping I said this right for you to comprehend it. There's a lot of different perspectives with this, and I know a lot of people that do this. So I've seen them, but the thing is, I never tend to watch them until you started talking about them. I never watched them either. I always knew they were there. I had a mentor that showed this in a lesson. And from my perspective, having a small account at the time, a few years back, I didn't think I needed to add time. I was so focused on why do I want to make 10% a day, sizing 20% of my port when I can size 5% of my port and possibly make 100% back. The whole idea with why I transferred into adding time, I transitioned into playing at the money. As my account grew, I wasn't comfortable risking money that could go away so quick. I wasn't comfortable holding positions down 50%, even though the trends were still holding. It was not very adaptable to my personality trait as a trader. I am very big on conviction. I'm very big on patience. I can play scalps on 0 DTE because I have the patience to wait. My issue is I'm not good at sizing correctly and selling or trimming. I want the major move off the zones. So when a zone rejects and I want to see it go higher, that one reject on 0 DTE, if I'm out of the money, my contract is obliterated. Instantly, my contract is down. This concept you presented is very helpful. I saw the contract chart before, but never thought of using it the way you presented. Yeah, so I know a lot of people, they actually chart on the contract chart. Like the way I charted is nice because when you see, like for this example, obviously it's the 4,100 call for SPX 0 DTE, but seeing this rising wedge and seeing the contract chart after the first two double bottoms and the two higher lows on this rising, on this sideways, whatever consolidation I like to call it, right away you know if that rising wedge on the actual S&P stays how it is, this zone's not breaking. There's no heavy push that will take this out of this consolidation zone. Up, down, up, down, up, down. Seeing this on the contract chart, I'm not in a rush to trade because I know already SPX is making headway. The contract's not moving. So I'm not going to force a play until I see a breakthrough and I see the contract readjust and catch the IV back on the upside. Once this dip happened and it caught momentum, this contract was perfect. Perfect entry, perfect sell point. Everything was good about it. I have to tame the degen in me, but the lesson you gave is definitely an eye opener, so I'm not risking so much. Yeah, so just going off what you said, Joe, the biggest thing with that too, it's so difficult to risk less to make less. I mean, it sounds like what you're risking less to make less. I don't know, like something about that to me, when you have more size, it sounds a lot better. But if you only have like $1,000 account, it's very irritating sizing $100 and selling for a 10% gain back to back to back. The overall picture, you're making growth. It's just very frustrating knowing there's people out there playing 0 DTE, risking money they can afford. You can't afford the money they're risking. And that's what makes it so aggravating when you follow other people. You watch other people's pockets. If you're focused on your account sizing, how much you can afford to put in compared to how much you can afford to lose, you tend to overlook yourself instead of looking at other people. A lot of stuff changes when you actually just focus on you and your personality, because you see someone make 1,000%, you want to follow them next time they trade. You want to catch because you think they can do it again. You're throwing your confident self out the window. You're throwing away your conviction to who you are because you'd rather put trust in another person. I will always put myself first when it comes to trading, only because the result is my fault. Win or lose, it's my fault. I'm not blaming the market. I'm not blaming another trader. I chose the fact that I'm waiting for this zone. I entered off this zone. If it doesn't work, I execute. I followed the plan. The one time you don't execute when you should and it runs, you're going to enter the next time when you should enter off execution, and it may not go your way. And you're going to right away think, oh, this system's not working. You're not going to hit every single time. So realizing, can you afford to risk less to make less? If you're able to risk more to make more, that's fine. But you have to realize this is a long-term game. You're trying to stick around. You're not trying to make quick money. If you're trying to make quick money, it's going to be very difficult to find a system that works, because one heavy loss, you're not going to want to do this again. Yeah, that's kind of why today with the 4130s, I went closer to in the money to be safe and sold early because I was uncertain, but I didn't realize till later PPI was the move. Yeah, so I think you said something below that. I saw the bullish trends, but PTSD was kicking, LOL. I didn't realize how much of a point move we could have made and didn't want to be too greedy at the same time. So yeah, that's another thing that a few people messaged me asking for my opinion on, like, how do you avoid chasing a play when you see it's still going upside on trends, there's no heavy pullbacks? How do you avoid entering when you've seen this before and it just keeps running? The only answer I can really give, if you miss the move, you can't chase where you could have gotten a better entry point on. If you could have entered at 2.00 and the contract's now at like 8.00, obviously you either play a more expensive contract price or you go out of the money more. Like originally you wanted the 4130s, you said. Yeah, originally say you wanted the 4130s, you missed entry. Now it's up 20 points at 4150. You're not going to want to play the 4130s again. You're going to want to play the 4160s, the 4155s. That means you have to readjust, which means you're paying more for a contract that you initially wanted to get at a cheaper price. I try and honestly stay convicted with who I've seen myself become, because whenever I chase, if I make money chasing, what did I really learn? You're not going to make money every time you chase. You're not going to find a gain from chasing. There's not really a lesson learned other than, oh, I chased and I got lucky, continuation kept going. If a breakout level hits, you can calculate that possible return based off, oh, if this level breaks historically, we run even more. I get that. But the one time you try and chase size and heavier because you don't want to miss it is the one time it pulls back, you sell for a loss, and that contract booms in value, and you could have made money if you just sized light and held the position. So a lot of why I use mirroring the contract is because it shows me what is possible. I have a visual idea of what could happen if a consolidation keeps happening. If a heavy pullback hits when I want calls, I know I can get it cheaper. I'm able to predict everything before it happens. All you have to do with learning this is know how to chart a stock or an index. You have to find zones. You have to know how to chart trends in the moment. You have to understand how heavy a pullback will decrease a contract based off looking at the contract chart. All of this stuff comes into play with the hours you put in, the time you put in watching this. For me, it was just watching it every day. When I'm looking at contract charts, I will always write down a month out. Okay, the $100, say a month out for SPX 4,200. I'm going to write down the price today. Let's see how much it moved going into next week. So I'll compare, okay, if I would have held this and swung it, trends held, we slowly uptrended, the value of that contract went up still. I can take that into account as I learn new situations with position sizing. I can use that as consideration when I play other stuff. So I'm always tracking, even if I'm not in a play. I'm always trying to learn with stuff I already know. I want to master it to a pinpoint. Does anyone have any other comments, possibly? Hopefully this wasn't too, I don't want to say confusing, but just a lot to take in. Because if you're not used to looking at the contract chart, this can seem very misleading. Like, how do you know when to enter? It's a contract chart. Contracts don't move off patterns. You'd be surprised how accurate contract charts can be if you just watch a specific stock enough. The repetition on these setups for the contract is so repetitive. A heavy pullback on a support bounce, you can catch it for even cheaper. Chasing it and watching it go down in value after you entered, selling for a loss just for it to come back. I'm always trying to learn, how can I take ownership into my hands when I chase the play and I could have got it cheaper. I wait for the next time I see the same setup. If it doesn't pull back, that one time the system did work, it just didn't have a pullback this time. So I track that. I write it down. Historically, when SPX is green on the day at 3 p.m., it pushes even higher 50% of the time. I'll find, that's not a real statement, I'm just saying something. I find stuff like that to use as a historical probability when I enter based off those historical setups. So I'm always calculating, I'm always documenting. I'm trying to find an edge, even when I feel like I already have an 80% edge. I want that 90%, that 95%. I'm always wanting to have favor in my trades every time. And I'm gonna